Hi, Dan Kerr's DK Analytics. It is February 23rd, 2017. Thanks a lot for tuning in. We thought we'd give a video update. It's been more than a month into the new Trump administration. We penned a little bit less than 2 weeks ago, hopefully a salient post on goings-on politically, economically, financially, and the tie-in to asset valuations of bonds and stocks and scarce assets and real money, silver and gold. And we hope you find that or found that of interest, and this is kind of an extension of that and feeding in some new developments or additional things that we've thought about that we'd like to draw to your attention. One of the things that caught my eye and I think is very, very noteworthy is that the United States trade deficit in 2016 reached a 15 or 16-year high, surpassing $500 billion. So America, in essence, despite the huge decline in oil price imports, or the cost of oil imports, it continues to widen its annual trade deficit with the rest of the world. The budget deficit I'll get into as well, but it gives one pause, and somehow it also aligns with the fact that corporate America, if one takes out inflation, the government statistics, albeit a misleading one, and one re-enters shares that have been bought back, U.S. corporations have been topless in terms of bottom line, in terms of EPS growth. I like to call it topless growth. Why? Because top line adjusted for inflation and stock buybacks, if you dialed back in the shares, is actually about 30 to 35% less than it was right at the top of the last recession. Right, so we delve into this in the post, and we've had it in slides as well. But that tells you that the earnings growth, the earnings per share growth, is financially repression based or financial repression based. It isn't organic top line based. It isn't investing in capital spending. It isn't in hiring people. It is thus not sustainable, and it paints a picture of the overall weakness of the U.S. economy at the big blue chip level, which unfortunately is complemented in the small cap and on Main Street, the people that can't avail themselves of the advantages that that big corporations can, thanks to their lobbyists on K Street, their presence on Wall Street, and the goodies that they hand out at the Capitol. Those small companies have been even harder pressed, and hard pressed not only by obviously Obamacare, but a regulatory morass, decreasing property right protections, increasing, in essence, unrepresentative government conducted not by a representative government, but by executive fiat within the administrative state. I think this misallocation, which is financed through the printing press, right? You run huge deficits, government deficits, if one takes the lipstick off of the government numbers that is published by the administration or administrations, and takes a look at the increase in the Treasury debt year over year. We have continued to run over $1 trillion deficits in the United States, right? That's how the Obama administration doubled the debt in 8 years, added about $9 trillion to it, more than $1 trillion a year. Yet we heard year after year about 400, 500, 600 billion deficits, which are outrageously big by themselves, but are a fraction of the true deficits, which is reflected in the growth in the debt tally and over $1 trillion a year. America is not alone. China is in this as well, as is Europe. The whole world has a printing press where savings aren't there to support prodigious government spending, out of control government spending, spending beyond receipts, tax receipts. They print the money into existence, and this is how we've continued to, in essence, increase debt beyond GDP growth, which is also a reflection of the terrible productivity or the decreasing productivity, despite all these cool gadgets we all have and see, the internet, the YouTube that I get to talk to you on here. In reality, we've had floundering productivity for quite some time, meaning lower growth in global productivity, and now more recently even negative productivity coming out. And if you don't have productivity, you cannot increase output other than by adding debt, which is, as we know, an unsustainable business model. Whether it's the family level, whether it's the state level, it's the national level, or the corporate level, after a certain period of time, it no longer works. Now, the difference here is that governments, central governments, can print the money to, in essence, sustain the unsustainable, and that's what we've been in. It's this, what I continue to call a poisonous public policy cocktail, a toxic public policy cocktail. This comes home to roost in not only lower productivity, thanks to the myriad of regulations, the regulatory compliance costs, incentives to invest based on tax schemes and avoidance and cronyism instead of on pure, unadulterated economic common sense. And that's where we've been, and that's where we keep going. And we're doubling down on it regardless of the new occupant of the White House, the new administration that we're in. So that is the risk. We have both politically and economically and financially a storm that we continue to sail into. We might be in the eye of the storm currently. When one looks at asset valuations, one looks at bond valuations, stock valuations, they're assuming a blue sky scenario, not a hurricane at the edges, and that is just not true, as evidenced by not only productivity but declining real growth and continuing debt. They all kind of reinforce each other, if you will, that those things are unmistakable. So the question here is, with inflation starting to also tick up, both in the U.S., despite a strong dollar, right? Despite a dollar has been going up and up as the least ugly currency amongst a collection of ugly currencies, or so interpreted. And even in the United States, inflation keeps going up. Real world inflation is easily 3-4 times the published number, but even a published number, it broke through 2.5%. Europe, which has been suffering from a declining euro, rightly or wrongly so, has inflation problems. So what happens if all of a sudden we get the disconnect? And in the United States, with the Trump administration, with lots of tariff threats, with large unemployment, large chronic trade deficits, the country not having the industrial fabric, the supplier base at this point in time to, in essence, regain the economic vigor that it would require to dig itself out of this hole. While you could argue to a larger degree Europe still has, and Japan might have, and China certainly has, we're in a precarious position. And this precarious position has a world which worships at the altar of a strong American dollar, but the emperor truly wears no clothes. So this might rejigger. We've got everybody crowded still into a dollar is the only game in town trade, the least ugly duckling of all the fiat currencies. I would argue that we're going to be in for a substantial surprise. And that surprise is going to be triggered by the realization that the true unemployment rates in the United States, the true rates of consumer spending, they're down in retail, they're down in auto, They're down in housing and mortgage applications. These are very interest rate sensitive businesses. And the cost of financing this stuff is up substantially over the last 8 months or so. We've got big bubbles, right? We've got big bubbles in student loans, which are outrageous, what it costs for an education, if not an indoctrination. Nowadays in the United States, we've got students that can't repay these loans, can't find employment, at least not what they studied in, or their field of specialty, if you will. And we also have cars, where people have been buying cars, and a lot of this stuff is backed directly or indirectly, just like Freddie and Fannie, by a government that's been bending over backwards to put, some shiny lipstick on a sick economic pig. So we've got bubbles, over $1 trillion bubbles in student loans and car loans. Last time around we lost the housing market was the weak link. I wonder if these two won't contribute, and what will happen. The Fed will ride to the rescue, and it will, I'm going to argue, sacrifice the dollar to try to maintain stability in the all-important stock market and bond market. So that does not speak well about real returns in either of those asset classes, much less prospects for capital appreciation, real capital appreciation. So we come back to the fact that bonds and stocks globally, for different reasons, yet connected through a global fiat currency regime, where no major country is tethered to the discipline of increased stores of above ground gold and silver in order to increase the monetary base. We don't have that. We haven't had it since '71. It's all very long in the tooth. And I'm going to argue that we're closer than ever to having a reset that might be brought about by any series of black swans, which are very numerous, as you know. Whether they're politically based, consider Donald Trump. Consider his ignorance of Smoot-Hawley. I have read that Donald is half proud of the fact that his wisdom and knowledge is such a quick read, but he doesn't read. He gets it through watching TV and the like. If we take a look at Smoot-Hawley, and I go through this in post number 17, the ramifications of a tit-for-tat trade war, especially for a country, the United States, that doesn't have the domestic manufacturing ability to cover all the component parts, much less fill the shelves at Walmart and Target, is extremely risky indeed, because America is so dependent, both in capital goods and consumer goods, on the rest of the world. Think that the United States is not in a position to manufacture an iPhone anymore. To get that supplier base back, to get the supply chain, to get the manufacturing know-how back. You can't just tell the world we're going to raise tariffs on and force people back overnight. This takes time. You don't do a tweet and then, the Monday morning you do a tweet, and Thursday all the suppliers and the manufacturing is back in the United States. This is a very long process, and it's a process that should be accompanied by a steadfast, credible commitment to reducing regulatory insanity. Donald Trump, I mentioned this in the last video, he has enormous power, if he were so inclined, to shrink entire administrative states, all these regulatory agencies that in essence make laws in the United States, not the Congress anymore. He can go to town, but this is ugly stuff. It's a tough war. It's very difficult to do. But if you really want to decrease spending, you don't focus, as mentioned, on the discretionary part of the budget and whittle it down to the 400 billion odd that you haven't already targeted for increases, such as infrastructure, such as veterans benefits, such as defense spending, right? You cannot credibly reduce government spending without taking the administrative state apart, which is nestled in the executive branch. And you cannot reduce regulations unless you do that either. And that's what ails the beast in America especially, but globally. We have green cronyism, green crony capitalists that end up making insane regulatory policies whether from Switzerland to Germany with the Energiewende, the energy shift, which has been a total disaster unless you're one of the green cronies. But ask an average German, ask a manufacturing company, ask the trains that need to run on times and peak power, and it's a disaster. So the question here is, can this revival in citizens around the world that want to bring back representative government in their respective countries that does the will of the citizens, not of the cronies or the elitists or the deep state or the immigrants, and tie that into sanity in terms of allocations being based upon sound money instead of the printing press. That is the $64,000 question. I'm going to argue here that so far it doesn't look too good. I'm going to say the glass is half empty. But even if it was half full, and that's the bottom line, even if it was half full, assets, bonds, and stocks are valued at levels that suggests that we could go through periods of a decade or more with, on balance, okay, either very poor or actually negative returns. And again, that's based upon how earnings, the earnings residual is valued in terms of stocks. And this isn't just the United States, it's globally. It's determined upon bonds that either yield nothing or even some still have a slight negative yield, such as in Switzerland. I mean, this is insanity. And the returns that people are going to get from purchasing or holding on to stocks or bonds that they purchased at very elevated levels, the risk there is huge. Think if you hold a bond and we do get a revaluation. You know, I talk with a lot of people and brilliant people in this industry and outside of it, and they continue to think that deflation is the bigger risks. They look at debt mountains. They say, you know, forget inflation. Debt is deflationary. People have lived beyond their means. Governments have lived beyond their means. All true. But when you can print money and it's politically expedient to do so, and politicians want to get reelected and maintain their privilege, consider how many politicians come into office in the United States and elsewhere with virtually no assets to their name, and once they come out, you know, they're 10, 20 million rich. How does that happen? It's called cronyism. Take a look at Post 17, if you would, for details. Or just think about it. It's pretty intuitive, right? It's not constitutional. It doesn't protect property rights. It's a shafting of Main Street and free capital, free market capitalism, the benefit of the privileged few that avail themselves of free money, right? And if we now consider how this is going to ultimately end up, it will end, as it always does, in tears for those people that stay on board very overvalued bonds and stocks. On the other hand, and herein again lies the big opportunity. And by the way, let's get to valuations. A small detour. If one takes a look at the Standard & Poor's 500, and there's global valuation yardsticks. I included them in my most recent post as well. There's a nice source link you have in the OECD world. 20 plus PEs, way over long-term average, and it's tied into debt. The more debt, the higher the PEs, because the lower the interest rates, the more money they print, and that allows us to accumulate debt and kill asset allocation, and with it productivity, because we've taken away the invisible hand of Adam Smith and have instead put bureaucrats or oligarchs in charge. But if we take a look at the valuation of the Standard & Poor's 500, it is eerily reminiscent of a value in October of 1929 when the stock market reached a PE of 30. This is based on Shiller's PE 10-year real earnings, an average over a 10-year period, real. We're very similar today. If one thinks back to 1929, 6 months later, we passed Smoot-Hawley. and a global economy, which was already on the precipice, fell into chaos and started to shrink thanks to a tit-for-tat tariff war. Now here we have Donald Trump threatening the same thing, whereas the U.S. needs to invite in foreign capital. It's what's financing our consumption and our capital spending together with our printing press. And we need to make them feel at home. We need to, at the same time, offer regulatory relief. I went into that litigation relief, what the Donald has majored in, the shaft subcontractors. He needs to do a 180 on, and grow a conscience and make it easier for companies to do business here administratively, because the litigation aspects or costs in America have even driven away big companies, and they're 2-3 times as a percent of top line of what they are in other Western nations. So double down on regulatory relief, show a solid currency path, get away from the central bank and the bail-ins and bailouts that have so polluted the system and are the essence of this poisonous public policy stew that we're in. Don't reward malfeasance, don't reward bad risk-taking, but reward the meritocracy of a marketplace where people that do end up with earnings have increased value for the rest of us because they've built mousetraps or services that we all want and need. If Donald Trump went that route, one could be a lot more sanguine about our trajectory. You don't beat up your foreign supplier base when you're not independent of them. You are totally dependent upon them continuing to send you vital components, subcomponents, and even manufacture goods as a whole. I mean, I mentioned in a recent post that Donald Trump flies from the White House down into the Carolinas, is standing next to the Air Force One, a 747, and then points over to a 787 Dreamliner, right, and applauds American manufacturing. And Boeing in the Carolinas, and we need more of this Dreamliner. We have to bring things home. At the same time, that airframe, that is the aircraft without the engines, is substantially overseas produced. The wings, the ultra-high value-added wings, and most of the fuselage is made in places like Italy and Japan, for God's sake. And without those components, there wouldn't be any 787 Dreamliner to sell. And you could say the same thing about cars and a raft of other things. So for him to antagonize the very companies that allow Americans to produce and to consume, and corporations, by the way, to achieve good returns, to have high margins. This isn't just the cost of goods in the United States, because the tariff is collected by the federal government. So you're actually expanding the bureaucracy, expanding government, and doing so unconstitutionally, because only the Congress really has the power, according to the Constitution, to legislate new revenue laws, not the president. But that's part of the problem here. We don't have the Congress standing up and doing its constitutional duty, whether it's creating new legislation, the power of the purse, demanding or getting new taxes or new revenues. That's Congress's constitutional purview. If you think about it in this way, if all these things go in a negative direction, that is tit-for-tat tariff or continued doubling down on a toxic public policy stew, then our valuations today are even more ridiculous and more endangered in terms of safety of capital, return of capital or purchasing power, much less a real yield, whether it's stocks or bonds. So we cannot afford, in my view, to just assume that the can continue to be kicked down the road without truly endangering the very investable assets, the capital that we will have to go forward with. On the other hand, if one can step back from this insanity and the daily news feed and the, and the CNBC and the Fox and whatever, and consider where we're really at in terms of economics, finances, politics, and juxtapose that against bond and stock valuations, then it is clear that we have a huge opportunity for those people that bought bonds and stocks at highly elevated levels, close to today. We then have what? We have an ability to let go, bring it into safe cash, set it aside, and wait for the market to come to us. Wait for us to be able to purchase bonds and stocks that have really terrific return perspectives and offer terrific capital gains opportunities and offer much more attractive dividend yields or bond yields. So if part of this is a repetition, I apologize, but the message is the same. In fact, the ugly bubble that Donald Trump referred to when he was running that would be pricked by rising interest rates is even bigger and uglier, and interest rates aren't lower. And the globe is less politically certain, and we're going in a dangerous direction, possibly with tariffs. And we're certainly not going to regain productivity by doubling down on what we've been doing wrong, right? So my stance is step aside, reduce exposure to those assets that you bought at very elevated prices. In other words, bonds yielding 1-2%, stocks that you bought that were trading at 20-25 times. Step back, be glad, take your profits, set them aside into dry cash that can't be bailed in or bailed out. We go into that in our posts 17 and 16. I'll steer you there for details. And by all means, consider purchasing physical, precious metals outside of the banking system. And while you're doing it, also shift a portion of your assets into scarce real assets that can't be printed, that typically when debt-based deflation morphs thanks to the printing press into money printing based stagflation, or even in extreme case hyperinflation, those things in the food and in the energy complex always get more expensive as expressed in depreciating fiat currency terms. So I'm going to argue as a closing statement that it isn't the debt mountains and the deflation that's going to rule. Rather, it's the political response to them. Why? Because they can still print the money to try to get themselves out of trouble, get them reelected, sustain their power and their influence and their wealth at the expense of the system. And it's only once that comes apart at the seams that we will really have the ultimate deflationary based asset price piercing. But on the road to ruin, if you will, valuation-wise and arguably economically, we have printing presses that will make sure, as they have shown in Germany, in Venezuela, in Argentina, in Russia, throughout history, whenever governments could try to double down on getting out of harm's way or keeping their posts and their fannies in power, they print. And then we want to not be afraid of debt mountains in the sense that we're going to have deflation that would be coming if we didn't have a printing press. Rather, we want to step aside and purchase assets that are going to be very much in need and demand that will get inflated thanks to the printing press and all debt-based deflations in history that I know of. When governments can print money, that is the central banks thereof, it's the same thing, have always ended in hyperinflation. That's my message for today. Thanks for tuning in. Bye-bye.